By investing in passive income streams, you can put your money to work for you so that you can work even less. And with enough money working for you, you may even be able to quit your job or achieve other financial goals. One of the most popular places to do this is in the stock market. So in this video, we're going to be discussing 4 ways that you can earn passive income through the stock market. Many people are under the impression that dividend stocks are the only way to get passive income in the stock market, but that simply isn't the case. While it may be the easiest strategy, there are still 3 other methods that you can use to create huge cash flow. So stay tuned for some of the best passive income strategies in the stock market, including the most lucrative one, which we're saving for the end of the video. Dividend stocks. Dividend stocks are without question one of the simplest and easiest ways for new investors to start earning a passive form of income. When public companies generate profits, a chunk of those earnings get paid back to investors in a distribution called a dividend. Investors can then either choose to simply pocket that cash and call it a day, or take that money and reinvest it into additional shares, which will eventually earn additional dividends. The amount of money you can get from these stocks is called the dividend yield, which is expressed as a percentage. The dividend yield percentage represents how much cash you'll get paid per year as a percentage of the stock price. So a $100 stock with a 4% dividend yield will pay you $4 per year. But keep in mind, dividend yields can vary quite a bit depending on the company, and they can also fluctuate from year to year. If you're uncertain about which dividend-paying stocks you should choose, then you should probably just stick to ones that are considered dividend aristocrats. A dividend aristocrat is defined as a company that is in the S&P 500 index that has a history of increasing its dividend value without missing any dividend payments. Dividend aristocrats specifically have a history of doing this for 25 years or more. Or, if you're looking for stocks with the highest possible dividend yield, historically speaking, REITs or real estate investment trusts are some of the biggest cash flow stocks out there. These are diversified portfolios of real estate properties that distribute the rental income back to shareholders. So it's a great way to invest in real estate without all of the headache. However, if you're not one for stock picking and you want this to be truly passive, index funds can be a great place to start, albeit having a lower dividend yield. Index funds are investments that hold hundreds or thousands of stocks in a single share. These often track the S&P 500, which includes 500 of the largest companies in America, or even the total US stock market, which includes over 4,000 different stocks. You'll get a small slice of every dividend within this portfolio, without the risk of holding all of your money in a small number of individual stocks. Plus, this index fund strategy is historically proven to beat stock picking over the long term. Stock lending. Stock lending has historically been reserved primarily for the wealthy and has had a high barrier of entry. But companies like Robinhood are making it easier for beginner investors to get in on this lucrative strategy. With Robinhood, users can turn on stock lending within their accounts, giving Robinhood their permission to lend out stocks in their portfolio. Whoever borrows these stocks will pay an interest rate on them, a portion of which will get paid back to you for initially providing those shares. After a match is made and shares are lent out, customers can track their earnings, see their current positions, and choose to disable stock lending at any given time. And even when shares are out on loan, customers can still sell those shares whenever they please while realizing gains or losses just as they normally would. To add a little peace of mind, eligible stocks are backed by cash collateral through a third-party bank. So there's no real reason why you should fear your assets are not being protected. Keep in mind that fractional shares aren't eligible to be loaned out. You have to have ownership of full shares to be able to participate. Stocks with a limited supply have a more significant chance of being loaned out and may also come with the highest returns. Covered calls. Options, as you may or may not already know, are contracts between 2 people, a buyer and a seller. A call option is a time-sensitive contract that gives its holder the right to purchase 100 shares of an underlying stock or fund. So, if you were to own a call option for a stock like Apple, you could exercise that contract at any time before it expires, enabling you to purchase 100 shares of Apple stock at the strike price, which is fixed at the time the contract is sold. This is attractive for investors who are bullish on a stock because it enables them to potentially buy that stock at a discount in the future. And while buying call options secures you the right to buy shares, a covered call is when you sell the call option yourself, thus giving someone else the right to buy your shares. So, instead of paying for a contract, you're selling contracts to someone else and collecting cash in the process. It's called a covered call because the contract is covered or secured by your shares. If a buyer chooses to exercise their call options, you'll be obligated to sell your 100 shares to them. This is absolutely crucial for you to understand fully, because whenever you're selling covered calls, there's always the possibility that you'll have to sell your shares in the process. Essentially, what you're agreeing to is placing the future of those 100 shares in the hands of the buyer and the market. And of course, the downside here is that you will have to own 100 shares of something to participate. But the upside of covered calls is that it's up to you to decide the exact conditions of your options contract and the scenario in which your shares could be sold. That means if there is some kind of time frame or price point that you're willing to sell your shares in the future, you can build your covered call contract around that to get the optimal outcome, while still collecting cash in the process. The way you can earn a passive income through selling covered calls has entirely to do with the cash premium, which is the amount of money you'll receive for selling a contract. People are paying for that contract, so you'll collect cash in your brokerage account as soon as your option contract is sold. Granted, if the price of the stock you're selling options on goes above the contract option strike price, you'll probably have to sell your shares. But you'll also keep the cash premium you collected up front. And if you picked a strike price you're comfortable with, you might be fine selling the shares at the end of this. On the other hand, if the stock doesn't go above the strike price, then you'll be pocketing that premium and you'll keep your shares too. Then you can just rinse and repeat to collect more cash. Generally speaking, investors can expect to earn between 1% and 5% every few weeks just by selling covered calls. With a sizable portfolio, this could generate huge income, perhaps even enough to pay your bills. Referrals. These companies are introducing a large chunk of the population to the stock market who might have not otherwise gotten involved. And as a way to increase their user base, these platforms offer referral bonuses to users who can get their friends and followers to sign up, link their bank accounts, and start investing. That means if you have a significant number of followers on social media, YouTube, TikTok, or your personal blog, you can potentially earn a semi-passive form of income simply by sharing referrals. We say semi-passive only because you'll first need to establish a following and then keep up with creating content to continue bringing in referrals. But if you're lucky enough to already have a large number of followers, earning extra cash through referrals should be a walk in the park. After your friends or followers use your referral link and get approved for an account on a site like Robinhood, you'll both receive free stock in your choice of one of America's biggest companies. You can then either hold on to that stock and let it grow, or sell it and pocket the cash. Currently, Robinhood gives up to $1,500 in free stocks every calendar year, but whichever trading platform you like to use probably has a similarly generous referral bonus. Other passive income strategies. While these aren't the only ways to generate passive income through the stock market, they are still some of the simplest ways for beginners to get started. Or if you're looking for other passive income strategies, you're in the right place. If stocks aren't your thing, check out these videos for some passive income business ideas that could help you quit your 9 to 5. Thanks for watching, and we'll see you next time.